Wall Street Week daily segment, the host of Wall Street Week, David Westin, joining us as he does every day at this time. And David, I know you were all over the big meetings last week of the IMF and World Bank, and you caught up with some folks here who I think we're really getting into the nitty gritty of where we stand in corporate America, not just what we're talking about with governments.
Well, exactly. And the banks. You and I, Romaine, have been talking about the aftermath of the rate increase on banks. We saw it with Silicon Valley Bank, but there are other companies that are affected as well by this really rather dramatic increase by the Fed in rate rise. And so Sonja Gibbs is someone from the Institute for International Finance who has studied this question over time. We've talked to her from time to time. We thought we'd check back in with her to see where those zombie companies, those are companies whose EBITDA is not enough to service the debt, where they are right now given where the rates are.
Well, I think maybe you should think of it in terms of medicine. Sometimes the medicine that you need to correct a condition really may taste awful and may make you feel ill for a short time before you get better. And this is the way it is with higher interest rates. Certainly we need higher interest rates. You can't maintain forever a period of ultra-low rates, and central banks around the world are addressing that issue. So over the longer term, it's going to correct the problem of too easy access to capital, too much debt, and so on. In the short term, though, higher rates are going to cause a lot of pain, and particularly for the kinds of companies that we've been talking about, these zombie firms whose earnings are not sufficient even to cover their debt service, let alone investment and operating costs. That's why we call them zombies. They're on borrowed time.
Well, and how long is that time? Do we have any sense of how long it takes? Because presumably they're going to have to renegotiate some of the debt as it comes due. It's going to be more expensive when they renegotiate, which just makes their situation worse.
Well, I think the difficulty is now we're heading into a period of slower economic growth while interest rates are continuing to move higher. So you have a tightening of what they call financial conditions. So access to capital is just getting a lot more difficult. So the next 6 months to a year are going to be very challenging in terms of making sure that companies can service their debt. If they need to refinance or restructure, reprofile their debt, that can be done on, acceptable terms, and that companies around the world, and especially small companies, which tend to have a harder time accessing capital in any case, can raise the funds they need to support jobs and growth and keep the economy humming along. So it's a challenging period over the next year or so.
So when companies do have to renegotiate their debt, do you expect it will be a problem of how much they have to pay on the interest on the new debt? Or is it possible some credit just won't be available at all? I mean, people are talking about a possible credit crunch, in part because of the problems we have with the banks here, in which case you couldn't get the credit no matter how much you're willing to pay for it.
I think there will be some instances like that. So the borrowing prospects of some firms have really tightened quite a bit. And the problem with higher interest rates is that there are ripple effects across all kinds of credit provisions. So, for example, you're also seeing tighter access to different forms of equity capital, to venture capital. So conditions in all kinds of ways to raise funds are not as good as they were even a year ago. Mostly, though, it's going to be a question of adapting to the higher cost of capital. So adjusting your plans. Maybe you'll have to scale back investment. Maybe you will have to not do that new hire that you wanted to make. So all of these things together create a rather challenging environment at a time when earnings prospects are already dimming in many parts of the world.